A very good morning, friends. I hope you're doing well. And today we've got a very interesting agenda for the day, and that is doing a very consolidated question on a consolidated financial statements. I remember that, we said that we'll perhaps do one question which contains a lot of, I would say, adjustments, including the concept of deferred tax and all. So today we are going to do that comprehensive question with you. I know the kind of question which I'm about to do with you perhaps is not come in the exams as well, but I think we need to be futuristic indeed. And the question which I'm going to do is containing a lot of adjustments, but I think that's going to give you a lot of clarity as well. And we are, of course, going to do it on the basis of the 7-step model which we have developed. And so that you can see that even if there are questions which are complicated in nature, that can be, of course, handled on that 7-step model itself. Now, I don't need to really remind you those 7-step model, but I think just quickly the names of those 7-step model, and then we can begin the journey. The first step was to get the acquisition date and the percentage. The second was doing the analysis of other equity. That's more like step number 2A. And then in step number 2B, getting the net assets on acquisition date. The step number 3 is the calculation of the purchase consideration. The step 4 is NCI. The step 5 is the goodwill. Then step 6 is organizing the other equity in the consolidated balance sheet. And finally, getting the consolidated balance sheet in step 7. So I'm now going to first read the question, and this is going to take some good time. And as I'm going to read the question, it might look scary. So I'm just, trying to create that background in your mind. So the idea is, of course, to open up the mind to see such kind of questions. So I'm now going to share the question. We're going to spend some good time reading that question first of all. So here was the question, and the estimated time to do this question is around 49 minutes, but we might, of course, spend much more than that. The reason in this particular case is that this particular question contains a lot of adjustments, which I need to explain. And I know this is mentioned as 25 marks. We do not get questions which are 25 marks. So again, the idea is to, do a question which contains a couple of good level of adjustments. Now we're given in this particular case, it says alpha, a parent with an investment in 2 companies, one is beta and the other is gamma, is preparing a consolidated statement of financial position on 31st March. So when you say statement of financial position, of course, it means balance sheet. And the following information is provided in the notes. So we're given a note number 1 where the balance sheet extract of the companies is given alpha, beta, and gamma. Now we can see certain references of notes given in the question, like investments has got a note number 2 and 3. PBE has got a note number 2. So I think at the moment, I'm not looking at the items where the notes are given. We can scroll down and we can start reading the notes. So you can, of course, make a guess that, this is going to contain 2 kinds of investment. One is an investment in the subsidiary and one is the investment in the associate. So now let me, I guess, read the inputs very carefully. Now, as we read the inputs, we are going to make some analysis also as we read. Now, let me just go back and tell you that we are given the balance sheet that is given on 31st March X2. The balance sheet is on 31st March X2. It says on 1st April X0, Alpha acquired a 75 million shares in Beta, and this is by means of a share exchange, which means Alpha acquired shares in Beta and which is giving shares against its own shares. The terms of the business combination is given. It says Alpha issued 2 shares for every 3 shares acquired in Beta. Then he says on 1st April X0, the market value of the share of Alpha is 3.5. So naturally, when you calculate a purchase consideration, we consider the fair value of the shares issued. I'm just thinking aloud. Then he says Alpha will make a deferred cash payment to the former shareholders of Beta on 31st March X3. I think the word deferred itself is indicative that there is a DC, a deferred consideration. And I think all the thoughts as you read the word DC should come to your mind that yes, we need to consider a present value, and we also need to consider the unwinding of discount as well. So it says we're going to make a payment on 31st March, $1 per share acquired. Then he says on 1st April X0, the incremental borrowing rate is 10% per annum. Alpha has included a liability which is defined in respect of this deferred payment. And that's right, the DC you rightly said is a present value of the future payment to be taken in the PC. Wonderful. And now if you notice something, it says Alpha included this liability in respect of DC on 31st March X1. Now we are given the balance sheet on 31st March X2. So when it says that Alpha included a liability in its financial position on March X1 at so and so figure, I think it's time to go back to the balance sheet. You can see the deferred consideration is appearing at 61,983. And I think if we scroll down to the note number 2, this is also, if you take the figures in thousands, it is coming to 61,983. Now, I think a little observation and a question to you. It says in this particular case that we have taken in the balance sheet a liability on March X1 that is 61,983. The figure appearing in the balance sheet on March X2 is the same which is appearing on March X1. So does this mean that he is omitted to take the unwinding for a period of 1 year? What do you say? So do we need to consider the unwinding for the next 1 year? And that's right. Now, my input is that if you see any kind of omissions, like in this case, it's been an omission for a period of 1 year. So I would say that it is always appropriate to consider an extract balance sheet. Yes, we need to consider an unwinding. And since it is a case of omissions, yes, we need to do one thing. We need to make an extract balance sheet. Before we prepare the 7 steps, what we need to do is organize, then extract balance sheet in this case. Then it says further, it is the sorry, it is the group policy to value the NCI. It says on the acquisition date at a fair value. As soon as you read that the NCI is taken at a fair value, your mind should immediately tell you that yes, the goodwill is going to be full. And if the goodwill is going to be full, then the impairment loss is borne both by the parent and the NCI. When you read that input, immediately your mind should start telling you that yes, NCI at a fair value as an implication of the goodwill being full. Then he says the market value of equity share in Beta on the date of acquisition is given, and that can be used for the purpose. So he's already given you the inputs in terms of what is the fair value of the share of the subsidiary. Because if I need the NCI at a fair value, we are given the fair value per share. Then he says on 1st April, Beta has got a retained earnings. So this is given for the purpose of analysis of the equity. Then it says, now comes the interesting part. So far, he's just been telling you about the purchase consideration as well as on the NCI. And then it says, directors of Alpha carried out a fair value exercise to measure the identifiable assets and liabilities on 1st April X0. And the following matters emerged. It says plant and equipment with a carrying amount of 100 million is got a market value 110. I think you can immediately recall that this is a fair value adjustments And that needs to be considered in analysis of other equity. That is step number 2A. And when you're going to consider this, you also need to consider the additional depreciation as well, and the corresponding impact in the consolidated balance sheet as well. Then he says the estimated future useful life of the plant was 5 years and the estimate remains valid. That is for the purpose of calculating the additional depreciation. Then he says Beta disposed of 20% of this plant since the acquisition date. Now comes a very interesting agenda. If you recall, most of the questions which we do, you're always given that there has been a revaluation of fair value adjustments and those assets are unsold even at the end of the year. But in this particular case, it says that 20% of the asset stands disposed. So the question rises, what will be the implication of this 20% disposal? Any guess on that? Because had there been no disposal, we would have taken the fair value adjustments in the pre-acquisition column, and we would have taken the additional depreciations in the post-acquisition column. But considering in this case that 20% stands disposed, any thoughts? What are you going to do because of the 20% disposal? How would it impact my analysis of equity? And I get your inputs on that. Disposal gain or loss will be recorded in the P&L. Okay, but that's accounting in the standalone financials. Any implications of that in the consolidated financials? Nobody. I think we'll see that when we come to the analysis. So we're going to see a couple of points in this question which are very interesting indeed. Then he says inventory with a carrying amount of 35 is also got a market value of 38 million. And this inventory also stands sold since the date of acquisition. So now another interesting point. There has been a fair value of the inventory, and it says this inventory has also been sold since the date of acquisition. So both inventory and a PPE, there is a fair value adjustments. 20% of the plant stands sold and the entire inventory stands sold. How do we deal with the disposal of the assets, which is being fair valued? We'll see. Then he says the fair value adjustments are not reflected in the financial statements of Beta. In the consolidated financials, the fair value adjustments are regarded as a temporary differences for the purposes of a deferred tax. Wow. Now he also tells me that since you are going to consider, this brings us to a very important agenda in terms of Ind AS 103. That when you consider the application of business combination on the date of acquisition, all the assets and liabilities are fair valued. And the carrying amount becomes the fair value for the purposes of Ind AS 12. But the tax base will remain the book value itself. There will be a difference in terms of, you can say, the carrying amount, which is equal to the fair value, and the tax base, resulting in a temporary difference, taxable or deductible, that needs to be identified. Then he says the rate of tax to apply to temporary differences is 20%, and on 31st March X2, we've also identified that goodwill stands impaired. I think you must be already feeling that this question is wow, because this contains a couple of interesting adjustments, I guess. Now let's go further to more adjustments. So after the investments in Beta is done, which is subsidiary, though we look at the percentage, but apparently, of course, it seems it is a subsidiary. Then he says on the date of incorporation of Gamma, Alpha got 40 shares in Gamma. So in this particular case, Alpha acquired a 40% stake. That means it becomes an associate. And that would trigger the concept of Ind AS 28, which is supposed to be a one-line consolidation. And then it says it made a payment of 32 million in cash. The payment investment is an associate, and I think that goes without saying. Because when you acquire more than 20 or more than 20, but up to 50, It is going to be a case of an associate as per Ind AS 28, and we need to apply an equity method of consolidation. The draft financial statements will recognize this investment at cost. So we are given that this investment is appearing at cost. That's right, significant influence. It says you can ignore any deferred tax implications of the investment by alpha and gamma. Then comes the note number 4. It says the inventories of beta and gamma on 31st March X2 included components purchased from alpha. Now we are of course considering alpha is the investor. Beta and gamma both are supposed to be the investee company. So when it says inventory of beta and gamma is including certain components, what is it? Upstream or downstream in nature? The sale is made by alpha to beta and gamma, and that's right, it becomes a downstream transaction in nature. Wow. Then he says alpha applied a markup of 25% on the production cost in arriving at the sale value of these components. So that means we are given the profit margin to calculate the stock reserve. You can again ignore the deferred tax implications of any adjustments you make due to this information. And then comes another note number 5 as well. That's correct. This is going to be taken in step number 6. I love that. So immediately when you look at the adjustments, your mind should start getting triggered in terms of which step the adjustments to be done. Super. Then it says the long-term borrowings of alpha on 1st April X1. Now this is the borrowings of the parent company. It says the long-term borrowings of alpha on 1st April X1 when they borrowed a total of 50 million. Alpha incurred an issue cost which is called a TC in terms of financial instruments. Now it says the exchange rate is given. Now in this particular case, since it's a little international question, you can see all the figures are given in terms of dollars. But this long-term borrowing is taken in terms of euro, which means it's a foreign currency loan. And if it is supposed to be a foreign currency loan, that means we need to apply the concept of Ind AS 21 as well. Wow. So you can see in the consolidation, we are blended with the concept of Ind AS 12. We're blended with the concept of financial instruments Ind AS 109 as well. And that makes a good question on a consolidation. So the exchange rate on 1st April is given, and it says on 1st April, Alpha took this $60 million in the long-term borrowings. So what he did, he applied to that 50 million euro an exchange rate of 1.2. So 50 million into 1.2, and that gives you $60 million. So he simply multiplied the initial borrowings with the exchange rate, and that is reflected as a liability in the balance sheet. And as far as the TC is concerned, this 1 million euro multiplied by 1.2 is being charged to the comprehensive income that is in the P&L. Is this treatment done correct? What they've done is they've taken a long-term borrowings, which means it's a financial liability. And when they took the TC, they've taken the TC in the profit and loss account. So as per Ind AS 109, am I supposed to take the TC in the profit and loss? Is there any other things which needs to be done? So if you recall in terms of 109, the TC in terms of a financial liability, is it adjusted in the financial liability amount? When you consider the financial liability at amortized cost, the TC gets added to the financial asset and it gets reduced from the amount. That's right. So we need to make a reduction to the financial liability, which means the computation of the financial liability also stands incorrect. That involves another rectification, and that becomes another point for an extract balance sheet as well. Then he says the borrowing requires you to make an annual payment if interest in arrears, that is to the extent of, it says 4 million euro. The average exchange rate is given and the closing exchange rate is given, and both of them is 1.25 euro. Alpha therefore charged a finance cost of $5 million to the comprehensive income. Now, what he's done, he has taken the interest of 4 million in this particular case. Now, the question is that if there is a TC, are you going to consider the interest at the contracted rate in the P&L? Or the presence of TC would trigger the concept of EIR? Because we know that whenever there is any inputs in terms of, let's say, you can say a premium or a discount or a TC, and that would trigger the need of calculating the effective interest rate. Wonderful. So which means the calculations of the interest is also incorrect. We need to rectify the same as well. Then he says the loan is payable on March X6 at 58 million. So that of course means it's going to be paid at a premium. And then it says the EIR is 11.1%. So he's already given you the effective interest rate, considering a TC, considering a premium, which is payable on the redemption. Other than that, described in the note, Alpha made no other accounting entries relating to this loan. You can ignore the deferred tax implications of any adjustments you make due to the information in this note. Using the draft statements of Alpha, Beta, Gamma in the note number 1 and the further informations in note number 2 and 5, prepare a consolidated statement of financial position on 31st March X2. How do you find the question? I think before we start, I think a couple of adjustments. It took us almost more than around 20 minutes time to just read the question. Doing it is going to be another extensive exercise. But I think what is the first, instance when you look at this kind of a question, which is contain a blend of Index 12, Index 21, because there is a foreign currency, and Index 109, which is also involving the financial instruments. Yes, apart from 110, apart from 103, and apart from that 28. That's right. So we've got a blend of a couple of standards in this, and I think this is going to give us a comprehensive revision on the concepts of various standards put together. But the best part of doing this particular question is you need to go step by step. So what we're going to do at this particular instance, we will filter out the information which is to be taken at each stage. The first filter which we need to apply in this particular case is make an extract balance sheet. So I think let's begin a focus now. So I'm going to do this on the Excel, and we're going to work this out on a step-by-step basis completely. So let's begin the journey. So I'm putting this as a comprehensive question. This is a comprehensive question on a consolidated financial statements. So I think before we start with this particular question, as we said, what we need to do, make some rectification of errors. And for this particular purpose, what we need to do, make a extract balance sheet, getting the changes in this case. Yes, Index 21 as well. Okay. So let me keep going back to the question. We're going to first of all come back on the inputs and go to the note number 2. Now in note number 2, we have seen the case EC. It says Alpha makes a deferred cash payment, which is going to be done 2 years later from the acquisition date, that is March X3. And then it says the incremental rate is 10%. Alpha incurred a liability 61,983. Now let me do some workings as well. So let us first of all deal with the concept of deferred consideration. So that is my DC. So let's first look at the computation of the DC. Let's go one by one on the dates. The acquisition date was 1st April. The acquisition date was 1st April 2000 X1, I guess. Let me just come back. Sorry, X0. The acquisition date was 1st April X0 in this case. So if I calculate the amount of DC, it says that we are supposed to make a payment of $1 per share acquired. Now it says in note number 2 that we've acquired a total of 75 million shares. Now we also need to consider that the balance sheet is all given in terms of thousands. So what would be 75 million shares in terms of thousands? So number of shares which we have acquired, we'll get all this information in terms of thousands. So we need to be very careful as we make the calculations as well. So 75 million, I guess, is going to be 75,000, I guess. 75 million shares in terms of thousands would be 75,000. So we are required to make a cash payment, and that is supposed to be, it says $1 per share. So we can say the total cash payment in this case is going to be 75,000. Now, what do we need to do in this particular case? This cash payment will be made. This cash payment will be made on, as per the instructions, on 31st March. It says 31st March 2000 X3. That's what is instructed, that this is going to be made on 31st March X3. That means X1, X2, X3, a period of 3 years later. So what do we need to do? We need to take the present value. We need to take the present value of this cash payment. So when I take the present value of this cash payment, this is going to be 75,000. And what would be the discounting factor? So we're given the discounting is at the rate of 10% per annum. So let's take a 10% discounting rate. 1 divided by 1.1, that's 3 times, is 0.751. So that works out at the present value. So let's consider 0.751 into 75,000. That works out at 56,325. Right, so that gives me the input as far as the present value is concerned. That's correct. Now, I'm very careful, making these notes so that we do not go wrong. And I think, of course, if this kind of question, if comes, which is, going to be a little rare, but I think we should be making very systematic working notes as well. Now, I'll do another small exercise just for conceptual clarity as well. So can I say this is the value which is computed on 1st April 2000 X0. We need to do an unwinding on 31st March 2000 X1. We also need to do an unwinding on 31st March 2000 X2. So we are given the balance sheet on March X2. So we're keeping it simple and we're keeping it till 31st March X2. So we're just going to look at the entries and the amounts which are going to look on 31st March X2. Maybe for a conceptual clarity, I can give you March X3 as well when the payment is made, but I think that's fine. So we can say on 1st April X0, the entry which we would have done is investment gets a debit. The entry would have been investment, in this case, gets a debit. So we would have taken the investment gets a debit, and we would have taken the deferred consideration gets a credit. I'm just thinking in large and picking up the entries which would have been done on the date of acquisition. So can I say this entry would have been done with which figure? Let me ask you that. When I would have done this entry on the acquisition date, so we would have recorded the present value of the future payment. So what is the figure with which we would put this entry on 1st April X0? Is it going to be 56,325, which is the present value we've computed in this case? Correct. Because we've already made the calculations of the present value of the cash payment. So this is the amount with which the entry will be done. Now comes 31st March X1. Can I say on 31st March X1, we need to go for unwinding of discount. And when we go in for unwinding of discount, the entry in this case is going to be finance charge. The finance charge will get a debit. And the deferred consideration is going to get a credit in this case. And that's right. I think you've given me the unwinding as well. Super. So the finance charge gets a debit and the DC gets a credit. And let's take the figures as well. I'll just shift this out here to the next cell. So in this particular case, a 10% interest, as you rightly said, is 5633 approximately. And then we also need to go for unwinding on 31st March, and that would be on the cumulative figure. That's right. So the cumulative figure in this case is 56,325 plus 5633. So the interest which is going to come on March X2 is going to be 6196 approximately. Great. So that works out at 6196. So let me also see that what is the figures of DC at the end of each balance sheet date. So when you did the unwinding at the end of March X1, 56,325 plus 5633, it stands at 61,958. And I think we can definitely get this matched. If I go back, it says 61,983. So this is 61,983. I think there's a slight little difference. So let me just get back, because this should have been matched with a figure which is 61,983. So maybe we can take more decimals, I guess, to match the figure. But I think we'll keep this same. So let me just, I think, take a discounting PVI factor for more decimal places. 1 divided by 1.1, 1, 2, 3. Let's take it as 7513. So we'll just take it a little more decimals to keep it accurate. So 75,000 into 7513, that's, I think, 56,348. Because we need to match it with the question, so maybe they've taken more present value factor decimals. So let's keep this 56,348. I think now we'll approximately reach that 56,348. One decimal place makes a lot of difference as well. So this is going to be 5635. So this comes to 5635. Now let's see what is the figure of DC. 56,348 and 5635 is, I think, coming to 61,983. I think that's now a perfect match. That now is a perfect match indeed. That's right. So I think since the question tells me 61,983, I think we need to match up the figures. So it's better to take 4 decimal places in this case. Great. Let's also calculate the deferred consideration, which is going to be on 31st March X2. So I think I need to change the interest slightly. This is going to be 6198. So this is going to be 6198. So considering the new figures, let's get the DC. 61,983 plus 6198, and that comes to 68,181. Wonderful. So I think this gives us the input. That's right, 68,181. So what we have done, we have made the calculations of the deferred consideration. So the company is missed out the unwinding for a period of March X2. So you can say the entry on March X2 is pending. So we need to incorporate this entry in the extract balance sheet, update the DC, that's one, and the finance charge will be adjusted against the retained earnings. So we'll take care of that later. So this is one omission which is given. Now let's go to the next one. So I think the concept of deferred consideration stands incorporated. Now it's time to go to the second omission, which is on the long-term loans. Now let's come to the note number 5 and incorporate the mistake which a company did on this. Now remember, all this is being done in the books of Alpha. The deferred consideration, the mistake is in the books of Alpha. The long-term borrowing mistake is in the books of Alpha. So we need to do all the entries and the extract balance sheet of Alpha, the parent company. So now let's quickly get the inputs in the note number 5. It says the long-term borrowings of Alpha arose on 1st April X1, wherein Alpha borrowed a total of 50 million. Alpha incurred an issue expense The exchange rates are given. Then he said he recorded $60 million in the borrowings and 1.2 millions in the P&L. The comprehensive income means the P&L. Then there is some interest payment, and we applied an exchange rate and took the amount in the P&L. And I think let's do one thing. So what we're going to do on this rectification, go back to the school days, what was done, what should have been done, and then get a rectification of errors. So what we're going to do, we're going to solve this in 3-bit pieces. What was the accounting done, what should have been done, and then get the rectification. So we got long-term borrowings. So let's consider the long-term borrowings in this case. So we'll go, first of all, what was being done. So what was being done, and then we'll see what should have been done. What should have been done so that we are able to get the rectification. So we'll put the rectification. So rectification of error, I think that is going to be interesting to watch, and systematically we'll understand the inputs as well. Okay, so I think let's begin the journey. So first of all, let's see date-wise what is being done in this case. Let's go back to the note number 5. It says on 1st April X1, which is the beginning of the year, they borrowed a loan of 50 million. And it says it incurred an issue expense, and that was taken to the comprehensive income. So the company did the entry. You can say bank gets a debit and the loan gets a credit, and they recorded this at $60 million. 60 million, I think let's put this in terms of thousand, I guess comes to 60,000, I guess, because we're taking all the figures in thousand. So they've recorded this at $60 million, 50 million into 1.2. So this is what they did. So just to show the workings, they had 50 million. That was in euro multiplied with the exchange rate 1.2. So this is the entry recorded on 1st April 2000 X1. So this is one entry which they did, and this entry was done on 1st April. Correct. Now let's go further. And then it says that the company in this particular case had an issue cost of 1 million euro, and that was taken to the comprehensive income. So on 1st April, we also incurred an issue expense. So what is the entry they did? Let me put it as profit and loss debit. The bank gets a credit, and the amount of issue expense recorded, this is to the extent of, in terms of million, 1 million became 1.2. So I think that's 1200. So this is also to show the working. They took 1 million, that's 1000, into the exchange rate 1.2. So this was debited to the P&L. So on 1st April, the company did the entry recording the financial liability at the exchange rate and also recording the issue or the TC in the P&L. Let's see further. Then there is an annual interest payment of 4 million euro, and this was also taken to the comprehensive income by applying the average rate 1.25. So on 31st March X1. So what they did on 31st March X1. So they did the entry that is finance charge, or let me put it as P&L. So this was basically the finance charge. So they recorded the finance charge debit. So let's put it as P&L only. So P&L gets a debit and bank gets a credit. So the amount they've recorded in this particular case is, so the interest was 4,000 in terms of thousands, and the rate of exchange was 1.25. I think that works out at 5,000. This was the entry which was done for the interest element as well. So let's come back on the agenda and let's see that we've taken care of whatever he said. So in the initial note number 5, we said that there was a loan of 50 million euro, and that was captured at $60 million done. The issue expense, which was 1 million euro, is been converted to $1.2 million done. Interest of 4 million euro is paid, captured at 1.25, that's at 5 million done. That's it. So these are the entries which the company has done. So I've just captured the entries the company has done on the 1st of April and on 31st March. This should be X2. So this is the entries done at the beginning of the year when the loan was taken, and this is the entry which is done at the end of the year. Okay, now what is coming at my mind is that I want to make, instead of entries, a ledger account to capture the things. Remember when we, did India's 21, if you've taken those regular sessions, you would recall that I always said that if there is a foreign currency involved, you can always make two columns on the amount side. One is in the foreign currency and one is in the functional currency. Do the accounting, first of all, in a usual manner, ignoring the currency. And then you can, simply convert it later as well. So that's what I am going to do in this case as well. Yes, I'm going to first make my ledger completely on the basis of foreign currency, and then we can convert things at the end at a later stage. So let's do one thing. We're going to first of all make the ledger of a financial liability. So let me make the ledger for a financial liability. So we're going to make a ledger account for a financial liability, which will give us wonderful results to watch. So let's take a column for particulars and the amount as well. Then again, take a column for the particulars and the amount as well. So we're going to first of all make this ledger in foreign currency. So I'm putting this in the brackets. This is in foreign currency itself. We're not right now concerned with the inputs that this is to be converted in a functional currency. That we can see later. Okay, so we're going to see this in terms of foreign currency itself. And I'm doing it systematic as well, so that once you revise this question from the Excel, you are able to do it on a very systematic basis. So I guess when we started off the entry, bank gets a debit. So can I say this amount should have been recorded at what? So this amount was 50,000 euro, and we should have made a reduction of the TC, which is 1,000 euro. Mind it, the ledger which we are preparing is in a foreign currency, which is in euro. So we borrowed a total of 50,000 euro, and there was a TC of 1,000. The TC gets netted off. So we will record this at 49,000. Now tell me, what is the next course of action in this particular ledger? Undoubtedly, this financial liability is being prepared at amortized cost approach. And if you're doing this at an amortized cost approach, would you like to give me some inputs? That what is the next entry we're going to do in this particular ledger? Any insights? Financial liability at AC, amortized cost approach. So what is the next status of entry in this ledger account? And that's right. So we need to convert this in INR at a later stage. But what do we do at this stage when we captured the financial liability? The finance charge. And can I say the finance charge is going to be considered at the effective interest rate in this case? So let's consider the finance charge. So let's record the finance charge in this case. And the finance charge is given, the EIR is already defined. That's right. So 11.1%, you're absolutely correct. So we are given the finance charge on this 49,000. There is a 11.1% EIR. Let's calculate the rate. 49,000 into 11.1, that's approximately 5439. So this gets recorded, and then at the end of the year, we also need to record the payment as well. This payment of interest is at the coupon rate, and the coupon rate is already given. That is to the extent of 4,000. So I think we can comfortably get the balance CD. We can definitely get the balance CD as a balancing figure. So this is going to be, I guess, appearing to the extent of 50,439. Wow. So that gives me the status of my financial liability in a foreign currency. And now I think it's time to convert this in terms of the functional currency as well. Because when I am going to make my balance sheet extract, we need to get the figure based on this. So let's convert this in functional currency. So we're going to convert this in terms of the functional currency. And this is going to be 50,439. And I guess the average and the closing rate was 1.25. So multiply this with 1.25. I think this works out at a total of 63. This is 63049 approximately. Wow. So I think this takes care of the inputs in terms of the what should have been done. So we've seen very carefully the entries which are done and the entries which should have been done. Now, what we need to do in this particular case is simple. I need a rectification of errors, so let me do some marking. The loan is appearing, I'm putting this in a red color. The loan is appearing in the books of accounts at 60. I think even if you go back, so even if you go back in the balance sheet, you can see in the balance sheet, there is a long-term borrowings, which is appearing to the extent of 60,000. That means the long-term loan is appearing in the books at 60,000, but it needs to be updated at 63049. So I think my life is simple now. We can simply say that this increase will be adjusted in RE. So I can just simply update the liability. So in the rectification, what we can do, we need to increase the financial liability, that is the loan. So can I say what will be the entry for this case? Increasing the loan would mean that RE should get a debit and the loan should get a credit. And you can simply update this at the figure. You can simply update this, you can say at the figure, which is 3049. So whatever is the difference in the loan value, that is 3049, we'll put the entry, RE gets a debit and the loan gets a credit. Wow. So I think with this, we are done with the status. We're done with the status, so I'll just show the workings. So we need to bring the liability at 63049 minus 60,000, which is already in the books of accounts. So updation of this liability gets recorded. I think we have taken care of all the omissions in this particular case. The omissions are done. Okay, now I think we're in a position to make an extract balance sheet as well. Though I think since we've done the entries, making the extract balance sheet makes a little more sense. Let's go further. Now let's make the extract balance sheet. I think the journey so far has been very interesting in this particular question because it contains all the rectifications, testing us in terms of a knowledge on the other relevant standards as well. I hope you've been able to catch up with the input so far. So all the adjustments, rectifications we have done so far, the consolidation process is not yet started indeed. We've just been working on the rectification of errors in this case. Yes, I look like single entry system and then a rectification. Okay, now considering the rectifications of error, I guess what I need to do is update the DC and update the finance chart. So this is the missing entry which needs to be done. So let's do the extract balance sheet. I think the changes are typically on the liability side. I don't see any changes practically coming on the asset side. So let's consider equity and liabilities. And we've got equity and we've got equity in this case. So the changes are going to be in the other equity section. So let me go back to the balance sheet and see that in the balance sheet, we're just given retained earnings. So we're going to make changes in the RE, retained earnings. So we're going to make the changes in the retained earnings. And then on the liabilities, let's take the non-current liabilities. We've got the loan. So let's update the loan figure as well. So my retained earnings in the balance sheet is appearing at 281167. This is 281,167. So now what we need to do, we need to go back on the agenda. And once we go back to the agenda, I think what we need to record is the finance charge. So reduce the RE by 6198. So this gets recorded, reduced by the finance charge 6198. And the RE also gets a debit to the extent of 3049. So let's also make a reduction of 3049. So two rectifications, the interest on the unwinding of DC, that's one, and the adjustment of the long-term loan. So let's get the new figure 281167 minus 6198 minus 3049. I think this works out at 271. This is 271,920. That is the new balance of retained earnings. And I guess we can take the loan as well. The loan is to the extent of 60,000 plus we amended it by 3049. So this was the change in the loan value. This comes to 63,049. And now another interesting question which comes to the mind is the DC. Is the deferred consideration going to be presented in the balance sheet as a non-current, or is it going to appear as a current liability? So what do you say when you're going to present the DC? Because now we are standing on 31st March X2 and the DC is going to be paid on 31st March X3. So when you're going to consider the presentation of the DC, is it going to be presented as current or non-current? Because if you notice, in the balance sheet, they presented the DC as a non-current liability. So what do you say? Is it going to be presented as non-current, or we're going to present this as a current liability, considering that just one more year to go to make the payment? So what do you say? Is this going to be presented as current or non-current in nature? 31st March X3 is what we need to pay. So one more year to go. I guess current in nature, right? And that's absolutely correct. No, not non-current. Because in this particular case, there is one more year to go. That's right. It becomes current in nature. So let me also present the current liability. Let's have the DC as well. So let's make the rectification of the DC as well. I'll show the workings. So my DC was 61,983, and we need to add 6198, 61,983 plus 6198, and that's going to give you the figure of DC. So I think now we can see very clearly the rectification. Yes, it's exactly 12 months, but yes, 12 months or less is both going to be current in nature. So DC comes to a total of 68181. That comes to 68181. Wonderful. So now you can beautifully see the double effect. You know, the rectification gives you a beautiful double effect. So you can see the double effect of 6198. The RE gets adjusted, the DC gets adjusted. The double effect of 3049, the RE gets adjusted and the loan gets adjusted. So we know that the double effect of this means that a balance sheet is wonderfully talented. Wow. So I think the extract balance sheet is done. Now we need to start with the consolidation process on a 7-step model. As I said, the estimated time is 49 minutes. That is without explanations when you start doing the question upfront. So since we are read the question, analyzed and explained, it's going to take wonderfully some time. So let's go ahead. Now let's begin the journey. Let's go to the step number 1, which is getting the date of acquisition and the percentage of holding. Now, in this particular case, we need to also now remember one interesting thing further. There are two investments made. So one is done in a subsidiary and one is done in the associate. So we need to be very careful as we proceed in this case, because we've got an associate company and we've also got a subsidiary. But let me tell you one thing. Ideally speaking, when you are considering a subsidiary and an associate, you need to be working out, two analysis, everything in terms of two. Because you have got a subsidiary and an associate, so you need two. analysis, you need two PCs, you need two goodwills, etc. But the best part and the safe part in this particular question is if you go to the note number 3, it says that the investment in Gamma is done on the date of incorporation. Now, since this investment is done on the date of incorporation, in this particular case, all the profits are post-acquisition in nature. And if the profits are post-acquisition nature, I am saved with the trouble of doing any analysis in this case. So what we'll do, in our 7 steps, we'll add another step later, maybe in terms of step number 5A, where we will concentrate on the investment in the associate company and we'll get the value as per the equity method. So when you got an associate company, you also need to get the value of the investment in the console. So I think that we can take care in terms of step number 5A. So at the moment, we are just going to just note down the dates of acquisition. So let's get the date of acquisition and let's get the percentage. And let's do this in both in the subsidiary, which is name of the company. I think I'll put the name of the company, Gamma and Beta. So this is Gamma and this is Beta. So let's now get the date of acquisition. So we're given in the note number 2. It says in the note number 2, the date of acquisition in Beta is 1st April X0. And we acquired 75 million shares. If you go back to the balance sheet, I guess we can see the share capital in the balance sheet is $1 lakh, $1 each. So I think that makes it, you acquired 75,000 shares out of 1 lakh share, that makes it 75%. So the date of acquisition is 1st April X0, that is 2000 X0. And we given the percentage works out at 75%. That is correct, absolutely. So yes, 25,000 belongs to the NCI. And in terms of Beta, so this is, I guess, the company we've taken. This was, I think, Beta. I think taken the other way around. This is Beta and this is Gamma. So the date of acquisition is done for the subsidiary and the percentage. Now let's go to the next company, Gamma. The date of acquisition is not given clearly, but we are given that it is the date of incorporation and the percentage is 40%. So we just make a mention that the date of incorporation is the date of acquisition, the date of incorporation, and the percentage is supposed to be 40%. That makes it a clear-cut case of an associate. So my step 1 is done. We've identified the acquisition date and we've got the percentage as well. Now we go to the step number 2A. And in terms of step number 2A, we need to do the analysis of other equity. So here we're going to concentrate on the analysis of the subsidiary only. As I made a mention, that in terms of the associate company, everything was acquired on the date of incorporation. So we need not, consider any inputs in terms of analysis because all the profit becomes post-acquisition in nature. So as we proceed with the step number 2A, I think let's first of all define what is pre and what is post. So we're going to make some columns, particulars. So we take particulars, we get the pre-acquisition profits, and we get the post-acquisition profits. We define the pre-acquisition, that is pre-1st April 2000 X0. And we define the post-acquisition from the date of acquisition, 1st April 2000 X0 to 31st March 2000 X2. Well, so I think that takes care of the inputs in this case as well. Now we need to go to the analysis of the other equity. Now, wonderfully, we need to be very careful. Now the crucial adjustments comes. I think let me ask you the question, because we did that earlier as well. And I think let's put that question back again. So when you're doing the analysis of other equity, can you tell me how many focus points do we have? When you're looking at the analysis of equity, I think I gave you earlier that we've got certain focus points in the question. So how many focus points do we get in terms of analysis. Wow, good, you remember that. So one is we're going to look at the balance sheet, other equity. Second is we're going to look at the fair value adjustments. And the third is we're going to look at the stock reserve if it is upstream. In this particular case, there is no upstream, it's downstream in nature. So I think the only two focus points is the balance sheet, other equity, and then the fair value adjustments. Let's begin. So let's go back to the balance sheet of the subsidiary. And we can see the retained earnings is appearing at 1 lakh. And we are given in the note number 2. It says in between, that's what is given out here, the retained earnings on the date of acquisition is supposed to be 80 million. So I think we can easily get the pre and post. Would you like to give me what is the pre and post? The balance on the date of acquisition is 80 million, that's 80,000. And the total in the balance sheet is supposed to be 1 lakh. And that's right, the 80 becomes pre and the 20 becomes post. So this is what we get, the balance sheet status done. Super. Then after this, what we need to do, we need to consider the fair value adjustment. So let's take the fair value adjustments now. Now this is interesting because we've got some deferred tax implications out here as well. So we need to be very careful now. So just watch this very carefully because this is now the crucial points which we need to discuss. Let's go back. So we'll go slow on this. Watch the entire inputs because this might be new for many. It says the directors of Alpha carried out a fair value exercise to measure the assets and liabilities of Beta on 1st April X0. And the following matters emerged. The plant and equipment with a carrying amount of 100 million has got a market value 110 million. The life of the plant is 5 years and the estimate remains valid. We're not considering the 20% as of now. We're just concentrating on the fair value increase. So 100 million is the book value and it is taken at 110. So I think you can definitely tell me what is the fair value increase in terms of the plant. So for the plant and equipment, there is an increase to the extent of 10 million. Wonderful. So we can take the plant and equipment. So we consider, first of all, there is an increase of 10 million, that's 10,000. And before we proceed further, I think I want to consider another input as well. It says in the last para, the fair value adjustments are not taken in the individual financials. In the consolidated financials, this fair value adjustment is going to be a temporary difference resulting in a deferred tax. Now, I'll show the workings also clearly so that you get easily revised as well. Can I say the carrying amount or the book value of the asset is going to be equal to the fair value, which is supposed to be, can I say 1,10,000? And the tax base is going to be equal to the original cost itself, the original book value. Because when you are going to update the fair value, for the purposes of Ind AS 12, can I say the fair value itself is the carrying amount for Ind AS 12? And the income tax authorities will give you a deduction equal to the book value. They will not consider the fair value. So what do you say? This difference of 10,000 which you are getting, is it a taxable or is it a deductible temporary difference? Wonderful indeed. That's rightly given. So this becomes a taxable temporary difference and this is going to lead to a DTL. And the DTL is going to be at the rate of 20% because we are given a tax rate which is 20%. Wonderful. So the only new thing which is coming in is that this fair value adjustments leads to a DTL. And when you create a DTL, it creates an expense. So in this particular case, this DTL is going to be a reduction in terms of the pre-acquisition column. That's the new addition. So go systematic. You need to first of all create the fair value adjustments in the pre-column. And if that leads to a DTL, minus. If that leads to a DTA, plus. Now let's go further. Now, once you have done this, it's time to take the additional depreciation as well. Because when you take the fair value adjustments, we also need to consider the additional depreciations also in account. How many years of additional depreciations do we need to consider in this particular case? So when you go to consider the additional depreciation, how many years of additional depreciation do we need to consider? The revaluation was done on 1st April X0 and we are standing on 31st March X2, which means a period of 2 years. No, not 5 years. 5 years is the total. That's right. We need to do it for 2 years because in this particular case, we are already past by 2 years now. It tells me that 20% of the asset stands disposed. Now, since 20% of the assets stand disposed, you should treat the 80% separately, which is still there, and you should treat the 20% separately. So what we are going to do, we will consider the additional depreciation on that 80% which is unsold. We will tackle that unsold portion separately, and we'll tackle the disposal portion separately. Now, so let's consider the additional depreciation. So can I say we need to consider depreciation on 10,000, but we'll take 80% of this because we're talking about the 80% is unsold. And we divide this by 5 years, which is the thing. What is the annual depreciation? I guess it comes to 1600, I think. And we need a 2 years depreciation. So we should be able to get a depreciation on this. So let's get the depreciation in this case. So 8,000 divided by 5, 1600 into 2, you get an additional depreciation that is 3,200. So this takes care of the additional depreciation on the asset. Good. Now you also need to consider one more thing. The DTL was created, and when does the DTL get reversed? The DTL is going to get reversed, in 2 cases. The DTL will get a reversal, number 1. When the asset is sold, the DTL gets a reversal. Number 2, when the additional depreciation is taken, the DTL will get reversed at that stage. So what do we need to do in this particular case? We also need to consider the reversal of a DTL. And the reversal of the DTL in this particular case is going to be on that 3,200. The charging of the additional depreciation will lead to a reversal of a DTL. So on this 3,200, we'll take a 20% and get a reversal of a DTL, which is income. And I think that works out at 640. So if you go systematic, it's going to be easy. Because in this particular case, when you're working out the inputs, so we know that when a fair value adjustments arose, it was leading to a DTL. And when you depreciate, it leads to a reversal. When you sell, it leads to a reversal. This takes care of the 80% unsold portion. Now let's come to the portion which is disposed. Now let's come to the portion which is sold. That is supposed to be 20%. So I'll highlight that portion, that there is additional depreciation on that 80% unsold. Now we're highlighting the portion 20% which is sold. Now, what do we do with the portion which is sold? Can I say number 1, the profit on sale needs to be reversed. The fair value increase needs to be reversed. Because in the standalone financials, the company must have recorded the profit on sale in the post-acquisition because they did not incorporate the fair value adjustments. So when they sold, they must have recorded that profit on sale. So this 20,000, can I say this 20,000 is including the profit on sale? Is my thoughts correct? That because when they sold it in the post-acquisition period, that means they must have recorded the profit on sale. So this 20,000 includes that amount, correct? So what we need to do now, we need to consider what is that 20%. So we can take out of this 10,000, we can take 20%, and this is going to be reversed out here in the brackets. That is a reversal. Wow. And what we also need to do in this particular case, sold on 1st April X2, it cannot be sold on the very same date. It has to be sold, because that is the date when you revalued. So I think it should be at least the next day, right? And now we also need to go in for a reversal of a DTL in this case. And that's going to be on this 2000, the reversal at the rate of 20% tax rate. And this is going to be an income that becomes 400. So now you can see the entire data very carefully. You can see the entire connects very carefully. And we can clearly see in this particular case that we made, first of all, a fair value adjustments, got the deferred tax implications, a DTL in the pre-acquisition column. The 80% which is unsold, depreciation and DTL reversal. 20% sold, profit reversal and DTL reversal. This takes care of the plant and equipment. Then there is another adjustment awaiting. It says inventory with a carrying amount of 35 million had an estimated market value of 38 million and the inventory is sold. So here again, inventory is also got a fair value adjustment. So let's take the inventory now. So let's organize the data in terms of the inventory. We know the carrying amount is equal to the book value. And this is to the extent of, I guess, how much? The inventory is got a carrying amount of 35 million and the market value is 38 million. So the carrying amount becomes the fair value. And that's right. So we can say the carrying amount in this case is 38 million. That's 1,000. And the tax base is going to be 35 million. So we're going to get a difference 3,000. Is that again going to result in a DTL? So we're going to get a 3,000, which is a taxable temporary difference resulting in a DTL. Super. So let's consider this is the taxable temporary difference resulting in a DTL in this case. And that's going to be 20%, that is 6,000. So let me just show the workings in the bracket as well, 3,000 and to 20%, and that gives me the status. Okay, that's wonderful indeed. Now we go further. So let me put this in the pre-acquisition column. So we can take the difference fair value increase out here, and the DTL will lead to expense that is 600. Now the question what comes further in the mind is it says that this inventory stands disposed of since 1st April. Now if this stands disposed of since 1st April, what am I supposed to do? If we say that it stands disposed of, then what am I supposed to do in this particular case? Am I supposed to reverse the profit on sale because if the inventory got sold, that figure of 20,000 would also be including that figure, correct? So we need to make a reduction. That's right, absolutely. So in this particular case, we go ahead and do the same reversal on the sale. So we can say 100% portion is sold. 100% portion stands sold. So I think for this 100% sold, what we'll do, reverse that 3,000 profit and reversal of a DTL resulting in an income. Wow. So I think that takes care of the inputs in terms of things. Now let's do one thing. Let's now take the sum total of the pre and the post. Wonderful treat, I guess. So let's get the pre-acquisition total in this case. This is coming to 90,400. Let's also take the total of the post. And this works out, I guess, at a total of 13,440. Okay. So I think this gives me the pre and the post acquisition inputs in this particular case. Wonderful indeed. Okay, so this input is done. Now we can go to the step number 2B in this case. So I think we've taken care of the inputs in terms of the pre and the post acquisition part. Trust me now, the complicated part of the question gets done. So at least we finish with the step number 2B before we go further. So now let's come to the step number 2B. I would advise you must definitely do this question by your own hands once. Because once you go do this question, trust me, you're going to get a lot of confidence in terms of things. So in fact, in the main standard India's 12, these are not covered as much. Yes. And I think we see the application of all this in terms of consolidation. Wonderful indeed. Okay, so now we go to the step number 2B. In terms of step number 2B, what we need to get the net assets on the date of acquisition. So we need to get the net assets on the. So let's now organize the data. So we know that once we get the net assets on the date of acquisition, it's going to be a sum total of the equity share capital as well as the pre-acquisition equity, as well as the pre-acquisition other equity, what you've already got in the analysis. So let's get the data from the balance sheet. What is the share capital? The subsidiary is got a share capital to the extent of 1 lakh. So we take this as 1 lakh. And the pre-acquisition equity is 90,400, which we have just got. And that is going to give us the net assets on the date of acquisition. Super. Okay, so this part is done. Now we are ready to go to the next stage. You want me to give you a break first, or you want me to continue with this question because it's going to take a little more time. So you want me to give you a quick 10 minutes break and then proceed further? Because we've got a long way to go further. The step number 2A is done. Now we've got more steps to follow. So what do you say? Before the technical starts, yes, I think that makes sense. So let's take a break, 10 minutes, and then I think we start back further on this. Things are getting beautiful and interesting. Okay, so I think we'll take a quick break, 10 minutes. I'll join you in 10 to 10 minutes time, friends. We continue this. Okay, thank you. Welcome back, friends. I hope you got a relaxation of mind. And now let's take the journey forward. So we're done the inputs till the step number 2B. Now let's go on further to the step number 3 onwards. So I think the interesting part is going to come when we come to the step number 6, and also we add the step number 5A as well, which is going to be investment in an associate, because so far we have not taken any inputs on the associate part. So let's go on to the step number 3 now. The step number 3 is on the calculation of the purchase consideration. And in this particular case, we're just concentrating on the subsidiary only so far. So as far as the PC is concerned, now we know the rectified consideration, because the investment in the balance sheet would now stand change. Sorry, the investment is the same, sorry, in the balance sheet. But there is one interesting thing, which always comes to my mind when I look at the step number 3. When you look at the investments in the balance sheet of the parent, there could be a possibility of, you can say, some outside investment. So when you do the step number 3, you should typically try to reconcile the purchase consideration and the investment appearing in the balance sheet of the parent, because there could be a possibility of some outside investments as well. So let's go back. If you look at the investments in the balance sheet, it is appearing at 263,349. So let me note down that what is the investments in the balance sheet of the parent company. That is, I guess, Alpha. So we'll just try to reconcile the inputs. So investments in the balance sheet of Alpha. So once we look at the figure, it was 263,349. So this is 263,349. Now this investments will include the investment in the subsidiary, that is beta. This will also include the investment in the associate, that is gamma. And then we can see if there is any outside investments or not. So once we look at the investments in terms of beta, I think let's go back to the note number 2, when it says that Alpha has acquired the shares in beta by giving 2 shares for every 3 shares. And the market value of the share is 3.5. So we can see that the purchase consideration in terms of beta was in the form of shares. We acquired 75,000 shares, issued 2 for every 3 shares. I think that works out at 50,000 shares. And each share is worth 3.5. So this is the consideration which is paid in the form of shares. So we issued 50,000 shares at the rate of 3.5. I think that works out at 1,75,000. Plus, I'm also given in this particular case that there is also a DC. So what was the DC? I think we calculated earlier. If you go back, the DC which we had calculated was to the extent of 56,348. That would be a part of the investment, 56,348. So now I think we can get the entire status of the investment in terms of beta. That's right. So this will give me the investment value. So we invested 1,75,000, fair value of the shares issued, and 56,348. This comes to 231,348. Okay, so this is the investment in terms of the subsidiary company. Great. Now let's go to the note number 3 and also look at the investment in the associate, where he's given that he is paid a 32 millions of cash. So the entire consideration is paid 32 million in terms of cash. So this is all the cash consideration. Now let's see if there is any balancing figure which is appearing in this case. So I guess if you take the sum total of this, I think it is 263,348, just 1 rupee difference. And that could be due to rounding off. So what we can do, instead we make this as 231,349 approximately to get the results, I guess. So this, actually this calculation is very important because that proves that if there is any outside investments or not. Because if there are any outside investments, that would be appearing in the consolidated balance sheet. So I think this is one calculation which I always tell people that when you do the step number 3B, sorry, step 3, you need to see that if there are any outside investments. So this reconciliation is going to be very important for step 3. Okay, so the step number 3 is done. Now we proceed further, and now we go to the step number 4. So what is going to be the step number 4 is the calculation of the NCI. So we need the NCI that is on the balance sheet date. And for this purpose, we are given some inputs on the NCI. So in is also, do we check any other investments as well? Technically, yes. Because when you're doing the consolidation, any kind of outside investments would be appearing in the consolidated financials. So I think every time, whether it is AS or Ind AS, you need to do that. Yes, analysis, associate investments, we'll come to that later. First, I think let's take the NCI, then let's take the goodwill, and then I think we'll add a step 5A for the investment in the associate in this case. So in terms of the NCI, we need the NCI on the date of acquisition, and this is as per the instructions at a fair value. So let's go back. So I think the NCI status was given in the note number 2. It is the group policy to calculate the NCI on the date of acquisition at a fair value, and for this purpose, the market value of the shares of beta is 2. So I think we remember that out of 1 lakh share, 75,000 acquired by the parents. So we can say 25,000 shares are acquired by the NCI, and the share is $2 each. That makes it 50,000. And then we can add the share in post-acquisition profits. We add the share in post-acquisition profits in this case. And where do we get the share in the post-acquisition profits? When we're going to add the share in the post-acquisition profits. So which step are we going to get that information? And that's right, we're going to get this information from the step number 2A. That's correct. So let's go back to the step number 2A. This was 13,440. So we can take 13,440. And there is a 25% belonging to the NCI. So 25% would mean 3,360. Is there anything else which needs to be taken in NCI? Any focus point in terms of the NCI calculations? Because when you calculate the NCI, we've also got another focus point as well. And that's wonderful indeed. I love that. I think the speed with which you're giving the inputs is wonderful indeed. Super. So we need to consider the impairment of goodwill. Since the NCI is a fair value, while reading the question, we identified that the goodwill impairment is going to be borne by both. So we take care of the goodwill impairment. So let's consider the goodwill impairment in this case. That's right. If there is PASNA, then there is no need. Good. So I think the goodwill impairment is defined. What was the impairment of goodwill given? In the end, it says goodwill stands impaired by 13 million. So he bears 25% of the goodwill impairment. And this works out at, yes, 3250. That's great. So I'm going to put this in brackets. And with this, we can get the status. And this is going to be 50110. That is the NCI. Wow. So I think with this inputs in hand, now we're ready to go to the step number 5. And that is going to be the goodwill calculations. Technically speaking, we also need the goodwill for the, you can say, associate company as well. But, we are not really bothered on that because number one, that amount of goodwill appears as a part of the carrying amount of the investment. And secondly, in this case, since the investment is bought on the date of incorporation, we can say the cost of the investment would not be different. So there will be, sorry, there will be no goodwill in this particular case. because when you acquire the shares in a company on the incorporation date, so basically the net assets and the consideration stands equal, so there is going to be nothing. So this is not the first time I'm hearing from you many times. That is what I'm remembering. Great. I'm sure you're going to see me in your dreams before the exams as well. Telling you, the focus points in terms of these steps, what you need to look at. I'm sure I'm going to haunt you in your dreams and the examination hall as well, telling you that, this is the focus point in terms of this step. Okay, so we take the purchase consideration and then we add the NCI on the date of acquisition, and then we reduce the net assets, which we have already calculated, net assets on the date of acquisition. So let's, I think, organize the data in this case. So we've got the purchase consideration. So what was the PC? 231. No, this is, yes, 231, 349. 231, 349. And the NCI on the date of acquisition is 50,000 taken above. And what was the net assets in step number 2A? 190,400. Okay, so this gives me the goodwill. Is there anything else which needs to be considered at this stage? Are we supposed to do anything else in terms of goodwill? Impairment. And are you going to consider 75% of the impairment, or are you going to make a reduction of the entire amount itself? That's good. Absolutely correct. We need to take 100% of this because we need to consider the revised goodwill. So it's always 100%. So less the impairment. And the impairment works out at 13,000. And this is going to give us the revised amount of goodwill. Right, 77,949 is the goodwill post the impairment. Super. Okay, that's wonderful indeed. Any adjustments for DDL on goodwill? Goodwill, if it results in a DTL, stands ignored. And if it results in a DTA, of course, stands incorporated. It's a good observation. But when you apply Ind AS 103, there is an exception in Ind AS 12 that if there is any DTL on a goodwill, it cannot be created, prohibited. But if there is a DDA, it gets created. So I assume that in this case, I'm not given any information. We're ignoring any deferred tax implications. Indirectly saying that it could have resulted in a DTL, but stands ignored. Okay, now I think before we go to the step number 6, what we need to do, we need to organize the information in terms of the investment in the associate. So let's go for the step number 5A. I'm adding the new step, that is investment in associate. That is investment in the associates. Because associate is going to be a one-line consolidation. So since it's going to be a one-line consolidation, we need to capture in this particular case the investments as one line. So let's see what was the cost of the investment. So that we've got the breakup in the PC. 32,000 is the cost of the investment. And I guess the only thing to be taken care out here, because we don't have any other inputs like stock reserve or impairment of the investment. So the only thing to be taken is the post-acquisition share. We need to consider the share in post-acquisition. So we need to consider the share in the post-acquisition profits in this case. So now let me make another statement again, though I think I've said that earlier as well, but let me make another statement. Since Alpha acquired the shares in Gamma on the date of incorporation, can I safely say that all the retained earnings in the balance sheet is post-acquisition in nature? That whatever Gamma earned is supposed to be earned after the incorporation date, which is supposed to be post-acquisition? Is the thoughts correct? And that's rightly said. That's right. So we go back to the balance sheet, pick up the RE. So the retained earnings is appearing to the extent of 1 lakh for the associate. So we can take that out of this 1 lakh. We can take the share And that is, I guess, to the extent of 40%, was it? Yes, we've got a 40% stake in the company. That works out at 40,000. That's right. There's nothing else which needs to be adjusted in this case. So that gives us 72,000 is the investment. So pretty simple and straight. The things could have become even more complicated had there been, the acquisition in the associate would have been somewhere in between, not on the incorporation. Trust me, you'll have to repeat all the inputs, all the steps for both the subsidiary and associate. Two analysis, two goodwills, of course, one NCI, but everything would have become two. Right, so this gives me the step number 5A, and now we are ready to go to the step number 6. So step number 6 is a very crucial step because we need the other equity in the consolidated balance sheet. So we need the step number 6. Now, tell me the focus points in terms of the step number 6. How many focus points do you get in terms of the step number 6? That is the agenda. I know you will remember that what are the number of focus points in terms of the step number 6, the number. Then we'll see what all is to be taken. That's right. That's 3 inputs again. The first one is we're going to first of all take the post-acquisition share. The second is that we need to consider the downstream stock reserve. And the third is the goodwill impairment in this case. So downstream stock reserve, goodwill impairments, and dividend, of course, is not there. And we need to consider the inputs with reference to post-acquisition earnings. So let's make the column particulars, and we'll take the column for alpha. So we'll first take the base, that is the retained earnings of the parent company. So where are you going to pick this up? Where are we going to pick the retained earnings of alpha? I want to hear that word. And that's right, balance sheet. Because we made an extract balance sheet, we made some changes to the RE. So we need to pick the figure from the extract balance sheet. Let's go back. So the inputs in the extract balance sheet is 271,920. So this is 271,920. So this is what we pick up from the extract balance sheet. That's correct. Now let's consider one by one. Add the post-acquisition share in the profits. So let's see the post-acquisition share. So I think if I remember, now what we need to do in this case, let's do one thing. Let's split this. We need the post-acquisition share in beta. So we need both the subsidiary and the associate. So we need beta and gamma. So I think beta, if I remember, was 13,440 into 75%. And gamma we have just seen was 1 lakh, and that was, I think, 40%. This is the post-acquisition profits. 13,440 into 75%, that's 10,080. And this is 40,000. So we can, show the bifurcation in terms of the post-acquisition in the subsidiary, the post-acquisition in the associate to get the breakup absolutely fine. Okay, then let's go ahead. And then we need to consider the goodwill impairment. In fact, when you're looking at the impairment associate, there is no goodwill impairment, but there can be investment impairment. But right now there is nothing. So I'm still, showing the inputs that this is beta and there is gamma, just making a format. Gamma, of course, there will be investment impairment, not goodwill impairment. So we take 13,000, I think, was the goodwill impairment, and 75% to be taken here. So this works out at 9,750. Okay, so I think this is done. I don't think so there is anything else which is pending in this particular case. The goodwill impairments are done, the calculations. Yes, there was a stock reserve, I think, downstream. So we need to take care of the stock reserve also. So let's take this again separately. for beta as well as for gamma. Now let's get back to the additional information again. If you go systematic, I don't see that there is much challenge. Okay, now we are given in terms of the note number 4, inventory of beta as well as gamma includes certain components purchased from alpha during the year at a cost of 15 million to beta and 12.5 million to gamma. This is the cost to the buyer. Can I say if this is the cost to the buyer, it is supposed to be what? The selling price. Alpha takes a markup of 25% on cost in arriving at the selling price. So 1/4 on cost, 1/5 on sale. So on 15,000, we need 1/5. So this is going to be on 15,000. The unsold good is 15,000 into 1/5. That I think works out at 3,000. Now I need the stock reserve from your side on associate. Give me the figure. The unsold goods with gamma is 12,500 and the profit is 1/5. So what is going to be the stock reserve in terms of the associate company? I think that's what is important to know. Because when you calculate the stock reserve for the subsidiary, you simply take 1/5. But there is something special which you need to consider in terms of associate. So would you like to give me what is the stock reserve for the associate? And I think I got the answers on that. And that's right. It's going to be 40% as well. Good. So we're going to consider the unsold goods are 12,500. The profit is 1/5. And we need a 40% stake of the associate. This is what is important. So 12,500, 1/5, 40% comes to 1,000. Because in terms of associate, when you're taking a stock reserve, you also need to consider the percentage as well. That is okay. I think this is done. So now we can get the status of the other equity as well. That is RE. And I think that comes to 3,08,250. Okay, that's wonderful indeed. So I think we've reached almost a good portion now. Associate is not consolidated, only the investment portion. Yes. So now finally we've reached the stage of doing the step number 7. Wow, this has almost taken us like what, around 2 hours to do. I know we may not expect a question like this, but I think any small adjustments, if it comes in the question, I think it's going to be a tremendous help. Because this takes care of a lot of adjustments, and even if it doesn't come directly, of course, I am apprehensive of this kind of question coming in. But in any case, if you get any of the typical adjustments out of this question also, I think we are done. We are done, interestingly done. Yes, line by line addition, net not applicable in case of associate. That's right. Okay, so now let's go to the step number 7. That is going to be interesting, making a consolidated balance sheet. So now carefully, we need to go on the consolidated balance sheet, picking up the items one by one. So let's start with the structure of the balance sheet given in the question itself, and we'll take up the information in this case. Let's begin. We've got PPE. So let's take the asset side, the non-current assets. We got a PPE. So as you make the balance sheet, I always say that, and it's appropriate that you take alpha, then you take the subsidiary beta, then associate is not to be taken, so we need an adjustment column. And then I think we can get a total column. So this will give us, a track in terms of what kind of adjustments we are making. So one column for the parent, one column for the subsidiary, and one column for the adjustments, and then we can get the total status as well. So let's go to the PPE. The PPE is appearing at 267. And this appears 267. And beta is appearing at 190. Any adjustments? Yes, there was a fair value adjustments. So we need to be very careful on the fair value adjustments, which we did. And in this particular case, I think if I go to the fair value adjustments, I think initially there was a 10,000 fair value increase. Then I think we had also gone in for an additional depreciation. So there was a fair value increase. That's right, 10,000, 20% disposal. And so we can take care of this. 2,000 was the reversal. And then there was, I think, also additional depreciation. And that was how much? No, no, not the deferred tax. We don't need the deferred tax. Deferred tax is going to be different. We just need the fair value increase, the reversal of the fair value increase, and the additional depreciation. That's it. So the additional depreciation was how much? 3,200. Okay, so this is all what we need. Do not consider by mistake any deferred tax inputs in this, because when you're going to consider deferred tax, we'll take separately. So you just need to concentrate on two elements: the fair value increase, the reversal of the fair value increase, and the depreciation. So I think this is going to give us the status of the PPE, that is 461,800. Next, the investments in this particular case is not going to appear except for the investment in associate. That is in terms of gamma. And I think we've already done the calculations of the investment. That was in step 5A, 72,000. So we picked that 72,000. That's out here. Good. So this is done. And I think next inputs in the balance sheet. I think nothing else on the asset side, but goodwill is there, right? So we need to fit in the goodwill calculated. So goodwill is there with us, 77,949. That is the goodwill. I think that's it on the non-current asset side with us. Then I think we can take the current assets. And in the current assets, we've got inventories, trade receivables, and cash equivalents. So inventories, then trade receivable, and then we've got cash and cash equivalents. So let's pick up the data and then see the adjustments. Inventory also, we've got some fair value adjustments to watch. So inventories is appearing at 85 and 50. So this is 85 and this is 50. There was a fair value increase in the inventory. I think that was 3,000 if I rightly remember, but then it was also reversed as well. So there was a stock reserve also. So stock reserve for parent, for the subsidiary asset both, or just the subsidiary? So what about the elimination of the stock reserve? Is it going to be only the company which is subsidiary? That's right. So this is going to be 3,000. So this is going to be 3,000. And I think that reminds me that there is one thing which we need to rectify. Tell me what? The investment needs to be rectified. Can I say for the stock reserve as well? Because when you took the associate company, we also had to eliminate the stock reserve. So least we forget, let's, I think, take that input as well, 1,000. So that will change the value of the investments out here because you need to take a double impact. So this is going to be 71. Okay, so this is done. I think the inventories are taken care. So this is the inventory, 132. Now let's go to the trade receivable. That's 75 and 45. 75 and that's 45. And I don't think so there is any intercompany owings which are given in the question. So no adjustments, I believe. So the trade receivables is done. Then cash equivalence is 15 and 10. The cash equivalence is 15 and this is 10 and there are no adjustments. So this gives me the input on the current assets as well. I think my asset side is done. Now it needs to be seen later with the liability side. Is the balance sheet going to agree or not? So let's take the sum total. This is 887,749. Now let's go to the liability side of the balance sheet. So we've got equity and liabilities. So equity and liabilities. So we've got equity, and within this we've got equity share capital. Then there is RE. Then there is, least we forget, NCI. So when you capture the equity, you should always remember to capture the NCI as well. So equity share capital is going to be picked up from the balance sheet, that is 195. We need to be careful, sometimes there could be some kind of inputs which you might have taken in the extract balance sheet. That also needs to be seen. So this is 195. I don't think so there was any inputs in the extract balance sheet. That is 195. Then I think on the retained earnings, we go back to step 6, 308,250. That's right. So this is 3,08,250. And let's pick up the NCI. And the NCI is 50110. That's right. Step number 4. So 50110. Good. So equity is done. Now let's look at the non-current liabilities. So as far as the DC is concerned, we're going to shift that in the current liability because we decided DC is now going to be current because there's just 1 year to go. So let's not take the DC. We'll take long-term borrowings and a DDL. So let's take the long-term borrowings. I think we decided on the long-term borrowings in the extract balance sheet, I guess. So we'll have to go back to the extract balance sheet as well. Long-term borrowings for the parent. Subsidiary, we can take 45,000 directly. So this appears at 45. And for the parent, yes, I think let's go back. For the parent, let's go to the extract balance sheet. And this is appearing at 63049. This is appearing at 63049. Okay, so I think this is it on the long-term borrowings. Now let's look at the DTL as well. So cover of adjustments on DTL, I think. So DTL is appearing at 21199. So this is 21,199. And the subsidiary, the DTL, is appearing to the extent of 10,000. Now a couple of DTL adjustments. You go back to the step number 2A and look at all the details. So I think we created a DTL on the plant that was, I think, 2000. Then I think there was a reversal on the plant. We need to go back. So there was a DTL on the plant was 2, 1. Then there is a reversal of a DTL 640 and 400. So 1040. We're going step by step. So 1040 reversal. Then I think let's go to the inventory. The DTL creation is 600 and the reversal is 600. So that effectively becomes 0, but I think I'll still show it 600 and the reversal is 600. I don't think there was any other deferred implications we have taken. So I think this takes care of the DTL as well. So that is 32,159. Wow. So I think my non-current liabilities are done. Now we are on the current liabilities. So let's take the current liabilities. So on the current liabilities, we've got Trade payables and short-term borrowings. Trade payables and the short-term borrowings. So now let's pick up the data. I think there are no adjustments on intercompany owings and all. So trade payable is 70 and 30. So this is 70 and this is 30. I don't think so there is any adjustments on the trade payable. I think so. And the short-term borrowings is 16 and 10. This is 16 and this is 10. So we get the status, that is 26. I guess hopefully, keeping the fingers crossed, our balance sheet is hopefully going to tally. So let's see the results. That is 819,568. No, there's some discrepancy. Did we miss out anything? I think I missed out DC. So let me take the deferred consideration. I remember missing the DC. Okay, so now let's, I think, consider the DC as well. Yes, so DC, we go back to the extract balance sheet again. So let's see what was the DC in the extract balance sheet. This is 68181. This is 68181. I guess hopefully that should be the only difference which is pending in the balance sheet. Let's now have a look on the total. This is 88749. Wow. So our balance sheet is wonderfully talented. That's superb duper indeed. Right. Inventory of associate figure reversal is not understood. Please confirm, sir. Okay. I'll just give you the inputs on that as well. You see, there were two stock reserves. One is for the subsidiary and the other one is for the associate. Now, when you're looking at the associate, you know what we did? On one hand, you reduce the investment. That is on the asset side. On the other hand, you reduce the retained earnings. So a double effect takes place. So when we did our step number 5A, we took the reduction of the stock reserve. That is the investments on the asset side. When we took the step number 5A, we took a reduction. Step number 6, we took a reduction of 1,000. I hope you got the input right. Okay, so thank you for the example, comprehensive. Most welcome. On the balance sheet, okay, yes, you can have a look at the balance sheet as well. Let me put it like this. You see, you need to remember that this adjustment of stock reserve for the associate cannot be done in inventory because the inventory of the associate does not appear in the consolidated balance sheet. Now, since that does not appear in the consolidated balance sheet, you cannot make adjustments to inventory. So you can see 1,000 gets reduced from the 71, and you can say 1,000 gets reduced from the RE. So if you focus on the balance sheet on the T shape, you can see reduction of the investments and there is a reduction of the RE when it is downstream. Now, if it is going to be upstream in nature, then in that particular case, you'll reduce the stock reserve from the stock and you're going to make adjustments in the RE. Right. So I hope you got the picture clear. And the interesting part is a balance sheet is, tallied to the extent of every single 1 rupee itself. Wow. So that was a comprehensive question in terms of the inputs on a consolidated balance sheet, blending all the standards. I think it takes care of 103, it takes care of 110, it takes care of Ind AS 28, it takes care of Ind AS 12, it takes care of Ind AS 21, it takes care of Ind AS 109. Beautiful. I hope once you're going to do this question by hand, you are going to feel very comfortable indeed. 25 out of 25. That's great. Okay, now I think since we got a little lesser time, we'll just, I think, maybe pick up a smaller question with you. We don't have time to pick up that larger a question. So I think I'm just going to pick up a small little question to you at this stage. In fact, what comes to my mind is that when we are looking at consolidation, I think one input which I can, maybe conceptually discuss with you, the disposal part, that, when you're looking at a disposal of the investments, In terms of Index 110, I think that's one part I think we didn't spend much time. So let me take the opportunity to spend, a little time on the concept of disposal. Because many people tend to get a little confused on the concept of disposal. And I would say broadly, when you look at the concept of disposal, there are typically, you can say, two cases. One is you can say that there is a loss of control, and the other one is that the control still continues. So let's make some mind maps to you. Maybe I can still keep asking questions, of course, to you, but let's make a quick little mind map on this area. So what my mind is now thinking is on the concept of disposal of shares. And when I look at the concept of disposal of share, what comes to my mind is two inputs. Because when you look at the concept of a disposal, you can say the disposal leads to either a case of a loss of control or the control continues. So when you say that there is no loss of control, there is no loss of control, that is the case one. Now, when there is no loss of control, like I think, let me put some questions to you. In this case, what is going to change from the consolidated financial statements point of view? The consolidation will still be done. Because when there is no loss of control, you were consolidating earlier and you're still consolidating. So what is the impact going to be? No change, yes. But can I say NCI? Yes, that's what I wanted to hear. The NCI definitely undergoes a change in this case. So we can say there will be two cases. One is a case of further acquisition. And I would say the other one would be a case of a sale, that is disposal, without losing a control. So let's see the journal entries in this case and make some crucial points. So when it is going to be a further acquisition, can I say the NCI will definitely go down? So you're going to put the entry NCI gets a debit and the bank gets a credit. Can I say the bank gets a credit for the amount which is paid, and the NCI is going to be based on the value of the NCI. Now, quick questions. Some quick questions at this stage. When you consider the NCI to be a debit, in this particular case, is it going to be shared in the net assets with or without a goodwill? Or does it depend upon the fact that if you are saying that the NCI is at a fair value, then you take the net assets including goodwill, and if the NCI is at a PASNA, then you take the net assets without goodwill. Is my thoughts correct? Is the calculation of the NCI dependent upon the fact that the NCI is at a fair value or at PASNA? Absolutely. So we'll just like to put a note out here, and that is NCI represents the share in the net assets. You can say including goodwill. You can say it is going to be including goodwill if NCI is at fair value. And we can say it is going to be excluding goodwill. It is going to be excluding goodwill. So it's going to be excluding goodwill if NCI is at PASNA. So you need to be careful when you're doing the calculations of this entry. You need to be careful that the NCI is going to be given a debit or maybe a credit on disposal. And that all depends upon, do we take the net assets including goodwill or not? And let's see the entry here. Can I say this is going to be bank debit? And this is with the amount which is received, and the NCI gets a credit. And that's again with the value of the NCI. The same note is equally applicable in this case as well. And where will the difference go? When you're going to capture this, where is the difference going to be translated? It is a transaction which is with the equity itself. The shareholders are dealing with each other. So the shareholders are dealing with each other. Is the difference going to be taken in the P&L or is it going to be taken somewhere else? And that's rightly given. It's going to be taken in equity. So let's put another note as well, that in this particular case, any profit or loss will be transferred directly to equity. So I'm putting it as equity. That is supposed to be so key. So we're going to put this directly in terms of SOKI. So this is one input. So the only caution which you need to be careful on in this case is that once you say there is no loss of control, the NCI needs to get a debit or credit. If it is a further acquisition, the NCI goes down. If it is a disposal, the NCI goes up. So you just need to be cautious that when you consider the debit or credit of the NCI, that needs to be worked out on the basis of, you can say, net assets, including, excluding goodwill, depending whether the NCI is at a fair value or PASNA. Great. Now let's see if there is a loss of control. If there is a loss of control, then what do we do? I think if you've attended the lectures on a comprehensive level, so you would remember that I always said, it doesn't make a difference whether it is a case of, let's say, a full disposal, or whether it is a case of a partial disposal, resulting in a conversion to an associate, or resulting in a conversion to a passive investor. What do we need to do? If I want to put an entry in the consolidated financials, so what are you going to do? Because when you get a control, you put the entry in Ind AS 103, the acquisition entry. So can I say if there is a loss of control, you need to basically go for a reversal of the same entry? And trust me, it falls in well irrespective of any permutation combination. Because in this case, whether it's a conversion into an associate or a passive investor or full disposal, just do the reversal entry of 103. Absolutely. So what we do in this particular case is the reversal of Ind AS 103 acquisition entry. So we just need to simply go for a reversal of the acquisition entry, and let me put it out here, irrespective, it is 100% disposal, irrespective it is 100% disposal or partial disposal. And even if it is a partial disposal, it doesn't make a difference whether it converts into associate or it converts into a passive investor. So irrespective, we do this entry. So I think that makes our life more simple. So now let's see what is going to be the reversal entry in this case. The bank gets a debit, because when he made a sale, the bank would undoubtedly get a debit. And can I say this is with the sale proceeds? You receive some money on the sale of the investment. What else? What else is going to be debited? Can I say the investment retained? And this investment retained is going to be debited at what value? Can you tell me? When you're going to consider the debit of the investment which is retained, what is the value at which you're going to record the investment retained? Wonderful indeed. That is fair value. So this is going to be at the fair value. Good. And then we also debit the NCI, and the NCI is going to be, can I say, on the date of disposal? On the date of disposal. And by the way, when you go to take the NCI, can I say this is going to be computed? You need to see the NCI on the date of acquisition, or maybe on the date of beginning of the year, and just add a post acquisition. But we need the NCI on the date of disposal. Then the credit is in terms of the net assets. And the net assets will again be, can I say, at what value? Can I say the fair value on the date of disposal again? The net assets gets a credit again, not book value, but say it comes at a fair value on the date of disposal. So that's going to come at the date of disposal again. And finally, we also need to give a goodwill credit as well. So this goodwill is what arose on the date of acquisition, or is it going to be less something? Because goodwill undergoes a change only on account of one factor. So when you go to consider the goodwill, this is the goodwill which is going to be, yes, wonderful indeed. We're going to consider the goodwill which is on the date of acquisition, less the impairment loss. Less the impairment loss, if any, that's going to be taken. So if you keep the focus points clear, I think that's going to be wonderfully taken care. Now, the question which comes to the mind is, where do you take the balancing figure? If there is going to be a profit or loss on sale of the investments, which is the case. So the difference in this case, yes, goes to the P&L. Unlike the case where there is no loss of control, it is equity. But if there is a loss of control, then it goes in the P&L. So in this particular case, when just putting it as P&L, assuming there is a gain on sale, and that is the balancing figure. Wow. There is another input which you need to keep in mind on the loss of control as well. Can I say if there is a loss of control? Let me now put a point blank question to you. Are you also going to make a scrutiny of any accumulated OCI which is being accounted for in the books of accounts? Especially, let's say, for example, it's a switch over from a control to an associate. There's a wonderful question which is there in the study material as well. I think is given in the later test exercises at the end. If there is a conversion of a subsidiary to a case of an associate, do you make a scrutiny of the accumulated OCI? And do you shift that amount from the other comprehensive income to the RE and the P&L? I don't know if you remember that. So am I supposed to make a scrutiny of the accumulated other comprehensive income as well? And then in that particular case, start making shifting? Yes. So we can put a small note out here as well, and that is the balance in accumulated other comprehensive income needs to be scrutinized. It needs to be scrutinized. And in this particular case, we need to decide that, in this case, whether it goes in RE or whether it goes in P&L. Can I see if it is a case of OCIR and if it is a case of OCINR? So can I say if it is a case of OCIR, are you going to take this in the P&L or are you going to take this in RE? If it is a case of OCIR, that is a case of recycling. And that's right. And if it is a case of OCINR, then it is going to be in the retained earnings. Super. This will get transferred in the P&L and this gets transferred directly in the retained earnings. So I think that takes care of the inputs in terms of the disposal part, because I think this is one input, I thought we didn't really too much do in the previous consolidation revision. So I thought it was a good idea to make some quick revisions, bifurcate this in terms of two cases. Yes, that is fundamental indeed. Right, friends. So I think that takes care of our consolidation, and that takes care of, some pending, I would say, issues which were a little underrated earlier. So we've taken care of that inputs as well. But I would, request and advise that, this question, you must do this, in fact, once again with the hands. So it's a wonderful session and many things are clear. That's great. It was always there at the back of the mind. And, I wanted to do a question, which contains the impact of consolidation with the deferred tax. And, once you do this again with a hand, trust me, you're going to get more confidence as well. So I think consolidation is one area that I think with this kind of a question, you should be able to crack it very well in the exams. I remember, last time telling you that this is my last session. And I think my friend told me, so don't say that. And I think the God heard you. And I think in this particular case, I'm back on the Monday morning out here. So now I have confidence. I remember that. Okay, that's wonderful indeed, friends. So I think, so any questions on your side at this stage? We're done with the consolidation process. So over to you for any questions you've got on your minds. Okay, so I guess no questions indeed. Okay, I get a one message. So we're blessed to have you, sir, on a hand and in mind. Thank you so much. I feel equally blessed. Thank you so much indeed. That makes my day. That's very encouraging words for me. So when the question is given dividend, we are a bit confused. Please, any short input. Okay, I think let me just give you a quick summary on that. If you're given a dividend, I did that in the revision class as well, but I think let me just give you a quick focus. If you're given a dividend in the question, the key focus one, when you do step number 2B, I'm putting it very clear, when you do your step number 2B, get your net assets before dividend and after dividend. That's one thing you should carefully do. So when you're given a dividend in the question, get your net assets in step 2B. One is before dividend and one is after dividend. Then when you focus on the calculation of goodwill, you need to consider net assets before dividend, whether it is for the NCI in goodwill or whether it is for the net assets. Get the focus clear that in the goodwill calculation, you need the net assets before dividend, whether it is for the NCI or whether it is for the net assets in the goodwill. But when you focus on the calculation of the NCI, you need to consider the net assets after dividend. So the arrangement of the two net assets will help you in the goodwill and the NCI. So when you focus on the goodwill, you need the figure before dividends. When you need the NCI, you need the figures after dividend. So I think the best input will be to organize the net assets before reduction and after reduction of dividend in step 2B, which will help you in the goodwill NCI calculations. Trust me, that way you will get your answers easily. I hope that answers your question on that. Great, wonderful indeed. You're most welcome. Right, friends. So I think that's all then in that case. So time to take leave from you. So thank you very much. Bye bye and take care. Thank you. Same to you. Thank you.